Good morning, traders. This is Mike with Vant Trading. I wanted to have a conversation with you today about what is the Fed and what is a Fed taper. We've been getting a lot of questions, a lot of emails asking us, to kind of explain what's going on with the Fed, what should we be looking at with the Fed going forward. So we wanted to put together a quick video to kind of go through what is the Fed, what is a Fed taper, and really what we're looking at going forward as far as market conditions for stocks. What is the Fed? Well, the Fed is the Federal Reserve System. It is the central banking system of the United States. It is independent from the government. It's self-sufficient, meaning that it gets no funding from the government. It has its own fees and interest that it collects on the securities that it issues, and that's how it's becomes self-sustaining. Now, the Fed, when we talk about the Fed, there are 5 roles that the Fed has, or 5 mandates, so to speak. The first role is to really keep and monitor a healthy economy, a strong economy that provides jobs and keeps prices in check. So really that dual mandate that you hear sometimes in monetary policy is the Fed is there to maintain and promote maximum employment and to also make sure inflation is in check, that we have stable prices. And of course, they're also looking to moderate and keep long-term interest rates within range. The second function is to promote stability of the financial system. And really what we're talking about here, and they're looking at systematic risks. So when we talk about when we talk about risk to the financial system, we talk about risk to the banking system. This is what the Fed's job is. The third function is to promote the safety and soundness of individual financial institutions. So they really are in charge of supervising and providing regulation to make sure banks are healthy and stable. And of course, for the monetary system, where we have one single form of payment, we want to make sure that there's confidence in that payment and also confidence in the institutions that are that you're issuing those payments and also that you may be keeping that money at. The fourth one is to foster payment and settlement system safety and efficiency through services in the banking industry. So the Fed's involved to make sure payments go where they're supposed to go and it's safe and secured. Now, they're not involved in every single portion of the payment system, not involved in credit cards. But when you talk about ACHs, you talk about wires, you talk about checks clearing, that's all part of what the Fed does to make sure that's safe and secure. And then the final one is to promote consumer protection and community development through really being out into the community and making sure that they're out in the community and they're helping to administer rules and regulations. So that's 5 roles of the Fed and functions of the Fed. Now let's get a little bit more into the structure. Now there's 3 parts to the Fed. First off, there's the Board of Governors. Now there's 7 members who are nominated by the president but approved by the Senate, okay? And one of those members is the chairman of the board, and that's when we talk about the Fed chair, which currently is Jerome Powell. That is the current chair person of the Board of Governors. And again, they are independent from the government. So they're nominated by the president, approved by the Senate, but the maximum term is 14 years. So, 14 years, pretty long time. Most typical Fed governors will outlast more than one term of president, and that's where you get the little independence in there. And the governors, right now there's only 6 members. So you have Chairman Powell, we have Vice Chair Claridia, we have Vice Chair of Supervision, which is Quarles, We have Michelle Bowman, we have Brainard, and then we have Waller. And there's currently one open seat that has not been filled and has been filled for some time now. The next entity that you have with the Fed is the 12 Federal Reserve banks. Now, even though we call the Federal Reserve the central bank, it's really a decentralized central bank. Because they have 24 branches, actually 24 operating branches out there, but there's 12 Federal Reserve regional banks, okay? And each reserve bank has a governor, okay? And they have 9-member board of directors for each bank. And again, they're all spread out through the different regions of the United States, and they oversee the member banks in their region. And then the third entity that we have with the Fed is the FOMC, the Federal Open Market Committee. That's what most of you are more familiar with, is the FOMC. Now, the FOMC includes the 7 board governors. It also includes the president of the Federal Reserve Bank of New York. Okay, the Federal Reserve Bank of New York always is part of the FOMC because the Federal Bank of New York is in charge of the actual execution of what the FOMC decides. Now, then there's 4 other regional presidents that are on the FOMC. And again, they rotated around, they serve on a rotating basis, but that really is what comprises the FOMC. Now, with that, though, even though only 4 members, 4 presidents, actually 5 presidents, if you include the Federal Reserve Bank of New York, is always on the FOMC. Even though they're the only ones that will get a vote into policy, all the other presidents and some of the board governors will be at the FOMC meetings and will give guidance and will give their opinions, but they will have no vote as they see. Now, the FOMC is the Federal Reserve's main monetary policy making body. It's responsible for all open market operations, and that's, again, executed by the Bank of New York. And that's including the buying and selling of government securities. And again, the FOMC is part of the mandate is really to regulate the supply of money. So when the Fed, the way they do that, if the Fed issues new securities, well, obviously what they're doing is in issuing new securities, they're pulling money out of the system, okay? And again, basic supply and demand comes into effect as far as how that would affect rates and such. And then when they're buying different types of securities, they're injecting new money, and the money supply then increases. Now, this is separate from what we typically hear and we talk about now in QE. Okay, and we'll get into that in a minute. Now, the FOMC is also responsible for officiating monetary policy. And again, you always hear about the Fed's dual mandate. Well, that's the first 2 parts of monetary policy, right? It's maximizing employment, okay, promoting a healthy economy to where there is a maximized, there's jobs being issued, and then also making sure that inflation is kept in check. So to help keep stabilized prices. And that's really what those 2 right there are, the dual mandate that we see in monetary policy. Now, what's the tools that the FOMC has to really, to have an effect on interest rates in the marketplace? Well, the first tool that they have is what's called the Fed funds rate. So the FOMC will set the Fed funds rate. So the Fed meets 8 times a year. And so part of what they're going to talk about is what is where's the economy? What's the projections for the economy? What are we looking at? They're looking at employment, they're looking at inflation, CPI, they're looking at durable goods, they're looking at manufacturing, they're looking at all sectors of the economy. And so really one of the tools they have, if they feel they need to come in and really kind of push the economy one way or the other, is by setting and manipulating the Fed funds rate. Now the Fed's funds rate is the rate, okay, set by the FOMC, at which banks borrow and lend their excess reserves to each other overnight. So part of what the Fed governors do is they set what's called the reserve requirement. And the reserve requirement is just a percentage of the bank's deposits that they must keep at the Fed in their reserve account. Okay. Now, the way banks make money is, we put money into the bank, either in the form of a deposit into a savings account. They give us a rate of return, typically 1 to 1.5%, right? Then the bank takes that money. They're paying out 1 to 1.5% to us. Then they lend that money back out. And sometimes they lend it back out to us in the form of a mortgage. Sometimes they lend it back out to somebody else. And then, of course, they charge a higher rate, right? We may pay 3% for a mortgage. And so the difference is called the spread. And that's how the banks make their money. That's one of the ways that the banks make their money. It's kind of changed a little bit going forward, but we're not going to get into that right now. And so what happens is a portion of those funds, okay, needs to sit at the Fed. And that's really, it's called reserves, and it's really to create financial stability. So, back in the 1900s, you heard about, before we even had a Fed, you heard about where there was runs on the bank. Well, the bank, just because you have, maybe $1,000 in your savings account, well, the bank doesn't have that money sitting in there, right? It's technically been lent back out. So to protect consumers, to make sure money is always available to them, they set this reserve requirement. So that way the federal, we talked about the Fed, that one of their mandates is looking at systematic, clearing of funds and payments. Well, that's why if you go to the bank and you get your money, there's a pretty much certainty guarantee that you're gonna be able to get your money out of that bank because of these reserves sitting at the Federal Reserve. Okay, so sometimes though, banks are caught short of their reserve requirement, and what they need to do is they need to borrow funds from some other banks that actually have more money sitting in it at the Fed than they really should. And so those banks will then lend that money to the banks that are short overnight. They'll charge a rate, and that rate is what's called the Fed funds rate. Now, it is the Fed funds rate is different from, the discount rate. We'll get in that later. But the key to understand is, how's the Fed funds rate, if they raise the Fed funds rate or lower the Fed funds rate, how does that affect short-term interest rates and interest rates as a whole? Well, what happens is with the Fed funds rate, typically banks will set their prime rate will be based off this Fed funds rate. Now, the prime rate is the rate that banks charge their best customers. So, prime customers, right? So that's the lowest rate that you can probably, really get on a loan if you're considered an A+ borrower. So the prime rate is typically set off the Fed funds rate, and home loans, auto loans, credit card rates, a lot of them are based off of the prime rate. So you can kind of follow that transgression. So what happens is, if the Fed needs to step in, like we had a recession back in the 90s, we had a recession in 2001, and the traditional way that the FOMC would handle that, when the economy goes into recession, they would lower the Fed funds rate. And by lowering the Fed funds rate, basically now it has an effect on short-term rates to bring short-term rates down. And so businesses out there, if they see rates are lower, that pretty much incentivizes incentivizes them to go out and borrow money and to take, which obviously to take on more risk. And then if they're taking on more risk, borrow more money, building more factories, that provides more jobs and adds a stimulus effect to the economy. So that's how traditionally the Fed would really handle the Fed funds rate. Now, again, what's interesting about the Fed funds rate is that it is not a mandate. Like, the banks don't have to charge the Fed funds rate. They can really charge whatever they want. So, really another tool that the FOMC had to make sure that they kind of affected those rates was the changes to the money supply, right? And I'm not going to get in M1, M2, but when you talk about changing the money supply, it's what we talked about before. If the federal government goes out, purchase securities, well, it's injecting money into deposits, and it's injecting money into the market. So supply and demand, if there's more money, if the money supply is larger, then that's going to make rates kind of come down because there's more money to lend out. So it's another way that the Fed would have, or the FOMC would have, to really affect and really manipulate interest rates, especially on the short term. Now, there's a new tool that the FOMC has been using, and something that you've probably been hearing a lot about in the news. It's really why we're doing this video. It's called QE. It's called Quantitative Easing. See, and what is QE? It's kind of a new tool, hasn't been used much in the past. But what is it? So the QE, it's where the Federal Reserve is buying interest-bearing treasury securities and pays for them with zero interest-based money. So they're taking currency, they're taking bank reserves. Okay. And by the way, this is reserves that someone must hold at every moment in time until that base money is retired. Okay. So if a bank has to keep a certain reserve requirement, that's key. So when you hear QE, that the Fed is going out and they're buying other types of securities, like right now where they're purchasing, I believe it's $80 million worth of MBSs, mortgage-backed securities. They're buying $40 billion, a month of treasuries. Well, what that is, there's a fallacy out there, and there's a lot of misinformation that QE is really affecting the money supply when it's not. I see even big known people out there talking about QE like it's really the effect is the money supply. And it's not, because what they're using is they're using these bank reserves. This is money that really is not in the money supply to begin with, if that makes sense. So really all it does is nothing more than replace interest-bearing government liabilities with zero interest government liabilities. So it's just like a little swap there. So it's not in their money, it's an asset swap. And this all started with the Great Recession in 2008. Okay. It all started with the Great Recession. So really QE, okay, QE never enters the economy. Okay. And matter of fact, when people, calculate M2 portion of the money supply and they include QE in that, it's really overstated technically by the amount of the QE. And I know we're getting a little technical in the weeds here, but that's an important point. So really, QE is nothing more than a sentiment issue to really spur the purchase of risk assets. That's really important point, that 90% or 95% of the people don't understand about QE. Okay. Stop it, man. It does not. It has nothing to do with really, it's not spendable money, nor is it money that was ever spent or ever will be spent. So I want you to really understand that point as we're going forward. Let's look at a little history here, because really what we're looking for, and we always talk about being a successful trader, is looking for the clues that give you an edge in the marketplace, that puts the odds in your favor. Well, one of the ways you can get an edge in the marketplace is go back and look and see, when have we had this before? What was the market's reaction before? And then look for those clues to see if we're following the same playbook. So the only other time we've really had QE, was the first time that really the Fed had to go there, was the Great Recession of 2008. And so let's go there and talk about that, and talk about why the Fed actually introduced this QE and why it actually went down this path. So the Great Recession 2008, guys, look, you remember when this was. It's when, the housing market came crashing back down. It officially lasted from December 2007 to June 2009. And really, it kind of is a good example of what happens when you have interest rates, when you leave interest rates at basically zero, when really the economy doesn't need that. Okay, so really the housing bubble that incurred leading up to 2008 was fueled by a sustained level of low interest rates, which created easy credit. And you also had this insufficient regulation, because you had all these banks, and if the banks make money, okay, by lending money out, okay, well, if they have if rates are so low that there's so much money in the system, well, banks, if the regulation is insufficient, then what happens is they have to find more borrowers, or there's only so many prime borrowers out there. So with so much money sitting there, they were all pushing to move and make more money. So they had to lower their credit standards and find more borrowers so they can, lend this money out. And so that created what was, really called the whole toxic subprime mortgage issue, where you had this housing bubble, that you had people that had like 400 credit scores buying homes. You had these zero interest loans for, 2 years, and it would just up, and then it's okay. Don't worry, you'd be able to refinance those loans out. I mean, it was poised for an ultimate collapse. And so just think about it. What happens if you're a borrower and you can borrow now? If you're working at a 7-Eleven, nothing against that, but now you're able to buy a $500,000 home, and for the first 2 years, you can afford the payment. But what do you think happens when it's time to refinance that loan, but rates start to go up a little? Well, that's going to cause a really big problem for all of these borrowers, because now all of a sudden they can't afford the homes, because it's all about, they bought it based off of cash flow. So if that cash flow goes up, then that's a really big problem. So, that's basically what happened. I mean, and the problem for the Fed was that the Fed funds rate was already close to zero. So we talked about how the Fed handled these recessions in the past to help climb out. Well, now the playbook was kind of flipped, because the Fed funds rate was already down close near zero. So they had to expand and find new policy tools. And, one of the new policy tools that they had was this QE, quantitative easing, excuse me. And the other policy tool they used, which was very effectively, which really all QE is forward guidance. So the Fed, turned to these additional non-standard or unconventional policy tools to help communicate to the marketplace that, hey, future short-term interest rates, we're going to keep them low. Okay, so bring on the risk. And then, again, they started this quantitative easing, and it really started with, because you had a lot of firms that were in danger of going down, meaning that you had several banks that were poised. We had Lehman Brothers go out of business, which was over 100-year institution. The economy, the reason they call it the Great Recession really wasn't because it was a really big recession. It was, but it was because it was really we were on the precipice of turning into a depression. You had banks that were about to go under, that were sitting with all these mortgage-backed securities that were just incredibly toxic. They had no idea what was in there. And for the first time ever, the money market, and most people treat money markets as cash, right? The money market, it's always priced at $1. Well, the shares broke the buck. Okay, and that had never happened before, put a panic into pretty much through the financial system. So they had to come up with an unconventional way. So between 2008 and 2015, the Fed's balance sheet, okay, which is the total assets that the Fed owns, ballooned from 900 billion to $4.5 trillion. Pretty impressive, but it was unique times. It's what they had to do. So let's look at the timeline, because they had 3 QEs all throughout the years. And let's look at the progression, and then let's look and see how the market reacted through this era. So the first QE was in November 2008. Fed began buying 500 billion in mortgage-backed securities, 100 billion in other debt, really Freddie and Fannie debt. Then in March 2009, the Fed balance sheet got up to $1.7 trillion. Okay, and then they also increased the QE to 750 billion in mortgage-backed securities, 100 billion in Fannie, Freddie, and 300 billion in treasuries. And then by June 2010, the Fed balance sheet, pretty much doubled and was at $2 trillion. Then they started we started to get a little bit of a calm in there, and then QE2, the economy just wasn't kicking in like they wanted. November 2010, Fed announced another QE, and actually that's 600 billion in long dated treasuries by mid 2011. And September 2011 is when we got Operation Twist. Now, Operation Twist was where it was a little bit different now. It was a maturity extension program. They were trying to manipulate the yield curve. So they were buying long-term bonds, but selling short-term bonds. And remember, supply and demand, right? And it's an inverse relationship. So if you're selling short-term bonds, that's making the rates go up. Okay. And if you are buying long-term bonds, that's making the rates go down. So you're compressing the yield curve there as they were trying to stimulate that artificially. And that's why last year you heard Operation Twist, at the Fed meeting where they're going to institute Operation Twist. Well, they thought they might do that again, but they never did go back to Operation Twist. So then QE3, the final QE, small little one, it was still Operation Twist, still was in effect. So you added another 40 billion in mortgage-backed securities on top of Operation Twist back in September of 2012. So how did the market react? Well, if you look here, you can see, and we got it all labeled. You had QE1 really kind of hit in here of November. It was right in here. Yeah, stocks we were still kind of in that downward spiral. Then the stock market based, and we had QE2. And if you look here, it looks very similar to what we've experienced, just maybe a little bit more whippiness, out of our recovery. I mean, so that February of our bottoming in 2009, took us all the way up through 2009 into the 2010, up to really February of 2010, that was our topping. So really for us, it kind of equates, right? We had our bottom in February of 19, took us all the way up, into this February here of 2021. And, had a little drop down in here, which, they recovered out. And then you can see here's where QE3 and Operation Twist came in. So the market, again, kind of the same type of market that we had from the bottom, went from 70 all the way up to 145, kind of doubled. And I don't know if you realize that, we had just doubled, the SPY just doubled from its bottom back in when we had made the February lows from COVID. So same type of market. So you can see here, guys, you got to be careful with what you got to be careful making definitive statements. But going back and looking at past issues, right? The past, the Great Recession of 2008, we kind of have acted this very same way all through the QE. So you may say, Mike, how are you able to be so positive? How are you able to go through and, kind of expect the market to keep on going? Well, because we had a playbook, and we used it as a guide. You don't use it as a definitive statement, but use it as a guide. Okay, so you can kind of see that. So moving on, so let's talk about the taper now. Because in 2008 was the first time we even got this word, not 2008, but 2013 was the first time we actually got, this word taper into our vocabulary as far as the Fed's concerned. So just kind of look at it. First off, what does taper mean? Okay, taper really is just the process of gradually stopping asset purchases when there was no predefined end date or amount before. Okay, so a taper, it doesn't involve the outright sale of the assets that the Fed owns. That's an important point, when you go back to that supply demand means, right? So it only means that we're reducing purchases to zero. The other factor I want you to understand, taper, getting rid of this QE, it's a sentiment thing. It has nothing to do with the money supply. Okay, so this should give you a clue. You shouldn't be afraid of this word taper. Okay, so let's look at when they started tapering. And Ben Bernanke was the Fed president back then. On May 22nd of 2013, Bernanke testified that the Fed may start to taper or reduce its size of QE. Now they didn't taper, they just talked about it, right? And if you heard of the taper tantrum, this was the taper tantrum, right? The yield shot up to 1.9%. On the long end, the short, TNX rose up 4%. The market dropped less than 1%. It was, it was pretty crazy, right? Now, September 2013, the market expected tapering to occur at a Fed meeting in September. It did not, and the market didn't react. So kind of sound a little familiar, right? Expecting Jackson Hole, expecting, the September Fed meeting, maybe to have some word of tapering, didn't happen. Tapering gradually occurred from the Fed meeting in December 2013 and ended in October 2014. During that time, okay, the market went up 12%, tech went up 19%, and yields dropped 18%. Okay, so let's take a look at the chart. Okay, here you see it, QE3. Okay, Treasury yields on the taper announcement went down. Okay, if you look here, you can see, the whole, you can see the taper tantrum that the market kind of had going into the summer. And then, they started talking about tapering, but still, again, kind of familiar, right? Seeing the 50 kind of be in value in here for the market. So the market expected taper. Nope, didn't happen. Taper began here in December. We got a drop, but then what did we do? Made new highs. Now, the one thing I will say is you do see a lot more volatility in here. We did get a drop below the 50, kind of came back close into this 200. But did we make new highs back in March and February? Absolutely, where we keep on going. And then taper ended in October. Okay. And interestingly enough, we actually had a flash crash in the Treasury bond market. So, interesting. That was the year that we had the flash crash. Stocks just, dove down below their 200. Really, there's never been any explanation for that flash crash, excuse me. But the market again, within a short period of time was back to highs. Okay. So, here's your guide, man. Here's what happened last time that the Fed tapered. Now, if you want to know really what the issue is with taper is it kind of starts the clock for the Fed raising rates. And that's what matters, guys. It's not this taper. This taper does nothing. Tapering's doing nothing right now. It does nothing, so I don't expect it to have a big effect on the marketplace. For us, we're going to be buying those dips, right? But if you look in here, okay, what happens though once the Fed raises rates? Well, then you start getting that downward motion. And here there's a lot of rumors about when the Fed's raising rates and, cause the market to drop. So really, taper, not much. The only thing the taper really does, in our opinion, is it starts that clock. And of course, then, there's a big issue there because then you have to worry about what you have to worry about as a trader is when they start raising those rates. Okay, so again, gives you a pretty good game plan here. So looking at the 2020 pandemic recession, shortest recession on record, it was really self-induced. March 15th, 2020, the Fed announced purchase of 500 billion treasuries, 200 billion in mortgage-backed securities. The balance sheet was 4.31 when they began. Fed expanded QE to unlimited in March 23, just a week later, May 18th. Fed balance sheet had grown to 7 trillion. The Fed balance sheet is now greater than 8 trillion. So we have some, the Fed has definitely increased their balance sheet. Now, what did we get? Just recently, we had going into Friday, Jackson Hole. It's now done with, guys. But the market reacted pretty good. And here's some direct quotes from Chairman Powell. The timing and pace of the coming reduction in asset purchases will not be intended to carry a direct signal regarding the timing of interest rate liftoff, for which we had articulated a different, substantial, more stringent test. So the market cheered that. Remember what we just looked at, those charts. Fed didn't care about tapering, but the Fed cares about what? Interest rates going up. That's what, the market doesn't care about tapering, but the market cares about interest rates going up. So seeing that this has nothing to do with interest rates, Powell went out of his way to say there's even a more stringent test. Well, that definitely, a market cheered that. They like to hear that. And then, of course, he added that while inflation is around its Fed 2% target rate, we have much ground to cover to reach maximum employment. Which is part of that dual mandate and necessary before rate hikes happen. So again, all the quotes were about, I got a lot of questions. Mike, I thought you said if they start going into tapering and all this other stuff. No, if they started giving you exact dates, that if you started coming in and saying, boom, we're going into taper, that starts the clock on interest rates. Didn't happen, didn't even give any dates. So, but he did give a lot of assurances around the Fed raising rates, very positive. That's why you had the market cheer it. That's why you had the market go up to highs, close at highs. It should be interesting going forward. So what do we expect from this taper? Look, treasury yields, that's what you need to look at. They fell during the last taper. I know that's counterintuitive, right? Because you're getting closer to raising rates. But, we really believe the pattern of the rates going down reflected the power of the Fed signaling, right? So rates are all about outlook, okay? And what happens is when you have the taper come in, you have the outlook really, what the outlook going forward is the call for slower growth, which causes the yield curve to kind of flatten. So with rates, the problem we have now is rates are already low, right? So we could see a different reaction, and the difference will be the outlook for the economic growth and inflation. That's what you need to look at, guys, to really get a clue for where rates are going and thus where the market's going. As far as the stock market, the market continued to rise during the last taper. We did see periods of volatility, but the 50 moving average provide to be value opportunities. We expect this to be still a good model going forward into next year because expectations for the economy are key. And what clues do we have for that? Well, this last earnings period surprised during the last quarter by 88%. We're not finished completely. And what we saw was 2022 expectations rose significantly. So right now, the forward-looking mechanism is that the economy is still going strong. What we don't know yet, obviously, is whether or not this Delta variant is going to be an issue and how that affects us. And there's one other major difference to watch out for, is that the fiscal response during this period, during the pandemic, it was dramatically different than what we saw during the previous recessions. Okay. September marks the end of these fiscal policy programs. And so, that's important. So the unemployment insurance is gone. The eviction moratorium was overturned for the final time. So what we're going to be looking at, guys, we're going to be looking at the housing market. We're going to be looking at the employment numbers for clues. This coming up this Friday is going to be really important from an employment standpoint. And should we see any weaknesses in either sector, that's going to cause issues for assets, risk assets going forward. So while there are some dark clouds on the horizon, you now know what to look for. Okay, you now know what to look for. We see exactly what the plan was last time. And right now, until we see an adjustment, until we either see the employment start really ratcheting up a lot higher than we expected, or inflation to continue to be a problem, or should we start to see weaknesses continue? We have seen some weaknesses in some of the markets, but we're going to be looking at interest rates. We're going to be looking at the dollar. But right now we are, looking at that 50 as the value zone, as it's been before. Taper's not the issue that we're looking at as far as the market having an issue. We're looking at forward going economic guidance, and we're looking at when the Fed's going to start signaling interest rates and when they're going to start looking at interest rates. So I hope this helped you explain a little bit about what's going on, helped to give you a little bit of a guide. Again, you can't take what's happened in the past and use it as a definitive model going forward. You have to know what to look at. You have to let your levels be your guide. And if you do that, you'll be fine trading going forward. Thanks, and I hope you have a really good week of trading. See you later.